The Footprint course, Unit 13, Breakout Trading. This is challenge day 24 of 30. In the following slide, we are going to focus on the harsh realities of trading in the financial markets, as well as some of the fundamental truths you need to learn and adopt.
The crux of it is, what color is the apple? And I'd like you to all just take a second now and think about it. What color is the apple that you can see on the screen? Take a while, think about it, and write down what you think the color is. Okay. Now, I'm pretty sure all of you, or most of you, have come to this conclusion that the apple is red. Okay? I think any logical, sane person would agree that this is a red apple. But what if I told you that, actually, I don't think this apple's red, I think it's yellow? What if I told you it was a pigmented apple? What if I told you it was a white spotted red apple? The crux of the matter, guys, is that what we are taught when we're young, what we are taught as we grow up, we hold on to that, we fixate onto that, and we are not willing to let go of that. In other words, I bet you, if most of you are standing in front of me now, you'd say, well, that's a stupid argument. Well, what's the point of that? Well, that is the entire point, is that you are not willing to look through the fact that actually this apple might not be red. Actually, it might not be red. Think about that. Put yourself in a different spot. What happens if this apple isn't red? What happens if this apple is truly yellow? And that's the crux of what tonight's about, guys. What I want you to understand is the markets don't reward the obvious. They don't reward. If you told me that apple's red, I'm going to say, well, brilliant, it's obvious. Everyone knows that. Okay? If the markets were rewarding the obvious, everyone would succeed. We wouldn't have such a high failure rate in trading. Right? The markets reward those who understand the rules and apply themselves according to those rules. Okay? Stop looking at the markets as wrong or right and start looking at them from a perspective of what made this market rally. In other words, if you came in, what the typical trader does is they come in on a morning, they have this preconceived idea, they've got a candle, they've got a setup, they've got a technical indicator, and they come in and they say, I want to buy this market. Why? Because, well, my predisposed opinion is that because of X amount of factors, this apple is red. This market is going to go down. Okay? And all of a sudden, when you enforce that into your belief system, guess what? Yes, it might work. Okay? But time and time again, it's not going to work. Why? Because when it is that obvious, it's not just obvious for you, it's obvious for almost every single other participant in the market. So stop looking at the apple as being red. Start looking at the apple as being yellow. Alright? So when you look at the markets, say to yourself, what made this market rally today? Not, I knew it would rally, but what made it rally? What were the key facts that told me or that hinted to me that rally was on? Was there high volume? Was there volatility? Was there a breakout of a triple top on a key level that we've held for the last 12 months? What was it that gave the clue the rally was on? In other words, what fact can I draw down from the market that made it ultimately rally? Why was it aggressive there? Why was it passive at this point? What made the market go sideways today? Why were there no stops when it took out this breakout point? Note, guys, when you start to look at the market from this objective approach, okay, just like you look at the apple from an objective fact base, which is there's red, there's yellow, there's white spots, there's all sorts of things going on there. When you look at it from an objective approach, guess what? You're going to start recognizing the patterns that exist within the market, the rules that your market trade by, and not the rules that you believe they trade by. You do that, you're on the right step for progress. don't forget, in this job in trading, you only need a couple of prices a day. You don't need to take a million ticks out of the day. Some of the most successful traders only take a few price increments every day. Okay, there are thousands of strategies, guys. You just need to draw up, just get a 1 minute chart, and you will see thousands upon thousands of strategies or movements within the market that you can learn to capitalize on. But you're going to have to get out of this ingrained belief that the markets are like a red apple, because they're not, and they never will be. Note, an apple is only red because you have been taught to identify it that way. Alright, stop being so delusional.
Hopefully that mentored session really provided you with some of the real truths about trading in the markets, and hopefully dispelled some of the maybe false truths that you might have had originally. Now, obviously, as we move into breakout trading now, this is the second of our context and footprint based strategies. This is very much a momentum strategy and very much an aggressive execution strategy. So just like every other strategy, we're focusing on a number of principles. Again, with the breakout strategy, there are some really unique principles we're going to focus on. The first being obviously initiative, identifying initiative and responsive price behavior. But then most importantly, how to identify those tops and bottoms, i.e. market context. So market context is vital to the breakout strategy. But then again, we're really going to focus all our attention on the interaction between the buyers and sellers around that break point. I'm going to introduce 5 fantastic signals or clues that the market sends you just before we get some really crucial breakouts in the market. Obviously, before we move on to the real breakout, I try and identify and highlight really the principles underlying a breakout. In other words, why does a breakout occur? What is required for a breakout to occur? Now, in order to understand that, we move ourselves back again into the concept of time frame participants. We focus crucially on the influential time frame participants and their role ultimately in the financial markets. Obviously, a couple of the other key components of this trade strategy session will be liquidity as well as again our color lines. Okay, good luck with the strategy session. Enjoy it. This is a fantastic trade strategy. It's going to show you some really good ways in which you can begin to execute your breakout strategies a lot more successfully. So into the strategy unit now of breakout trading. Now, I know a lot of you are probably very excited about this strategy session, simply because breakout trading is probably something most traders have at least experienced in some format. Now, my hope is obviously by not just the end of the strategy session, but by the end of the unit, you'll have a very objective, processed approach to executing your breakouts. Okay, the information I'm going to give you in the next couple of moments, you're going to begin to realize that breakout trading, whilst is seemingly obvious, it's actually filled with some really big pitfalls in which most traders fall into. Okay, now what I am going to say is that if you do follow the really process-based approach I'm going to show you, you can increase the probability of your success with breakouts tremendously. Okay, now before we move on to that, I just want to talk very briefly about this concept of right and wrong. Okay, unfortunately, in this day and age, we tend to think that things are either right or wrong. And unfortunately, we taught this from a young school age. When you write a test, you get given a tick or a cross. So everything in our lives is right or wrong. Trading's no different. If you do well, or you do seemingly well, you make profit. If you do seemingly badly, you make loss. Okay, now I really want you guys, if there's one thing I can get across in the strategy session, lose the idea of right and wrong. There's no such thing in trading. Okay, I've seen traders do what I feel is seemingly the wrong thing at the wrong time and make a lot of these things, make a lot of profit. Okay, I've seen traders do the right things at the right time and take a big loss. Okay, so there is no right or wrong in trading. If you can start off by believing in that principle, you're really on the right process to a growth mindset. Now, the reason I want you to get away from this idea of right and wrong is because when you start to think things as right or wrong, you naturally start to create a bias. Okay, and when you create a bias, you can no longer have a growth mindset. In other words, like I said to you, if I showed you obviously a red apple, okay, it doesn't matter how much I argue with you, it doesn't matter how much I try and prove it to you that it's not red, okay, you've got a bias, okay, you know what red is, you're never going to believe my side, doesn't matter how much objectivity I can show you, you're just not going to be willing to listen and learn. Okay, now that's obviously the first element I want to sort of mention. Now the second thing is, and it came out of the mentored session, was this concept of an exact approach. Okay, a lot of young traders, even a lot of developed traders, are really going in search of an exact approach. They almost want, some form of a 100%. If A equals B, then do C. Okay, now unfortunately guys, we are discretionary traders, we are not algorithmic traders. Okay, so by that very definition, if you want to develop an exact process, right, then you need to obviously look more towards an algorithmic type of approach. More importantly, remember, if you do go that way, the rules change again. Okay, there's certain rules governing algorithmic trading, there's certain rules governing discretionary trading, there's certain rules governing hedge funds, okay, there's certain rules governing institutional trading, right? Those rules differ depending on what in which element of the market you find yourself. Now, note the last thing I want to sort of just mention, and this is something I've learned throughout my career, and you're going to learn this through the books that I share with you. The reason I recommend these books, okay, is not because I think they're going to teach you to become great traders. Okay, I give them to you because I want them to provoke thought. Okay, now when your thoughts are provoked, one of two things is going to happen. Okay, you're either going to adopt the principle, in other words, you're going to believe in the principle, you're going to adopt it into your everyday life, and it'll become a part of you, or you're going to ignore the principle, okay, and you're going to move forward. Now, that's the purpose of every book. I want to provoke your thought, and I ultimately want you to adopt some principles that you find valid and ignore the rest. Okay, but the most important thing, and this is the key to thought-provoking principles, is that just because you adopt a principle does not make it yours. Okay, and this is the same in trading. We see there's so many successful strategies, so many successful trades. You know, I'm showing you guys 10 unique strategies here. Okay, now it's so important that you recognize the real truth, which is that I can only show you principles. Okay, I can only give you the principles. That's all I can give you. Yes, I can show you trade strategies that work well. Yes. Okay, but what you have to accept is that you cannot simply just try and adopt my principles and become successful. Okay? You have to adopt those principles, and then most important, apply yourself. Okay, because it's this self-application, right? That's where you go into the market. That's where you test out these principles. That's where you utilize the footprint in a number of examples, and you find a way, you find a strategy. That application, that's where the real money comes from, guys. That's where the real edge is developed. Okay, I'm not giving you an edge, yeah? I'm just showing you some principles and strategies. Okay, you're going to have to give yourself an edge through self-application. Okay, now note, obviously we are talking about breakout trading. Now, I just want to talk about the key elements to breakout trading. But before I do that, before we can understand breakout trading, let's understand, why do so many people fail? Okay, so all of you should be saying to yourself, well, yeah, okay, breakouts are pretty obvious. Okay, you just look at a chart, there's maybe a double bottom or a really key inside day, and therefore there should be a breakout. Okay, so we're all good at identifying it. But guess what? If you can see a chart, so can every other retail trader in the world, so can every other algorithm in the world, so can every other banker in the world. Everyone can see a breakout. Okay, so the first thing to note is that a breakout is obvious, public knowledge. Now, I hope straight away you're going, oh, okay, I didn't realize that. Because guess what? If a breakout is public, obvious knowledge, then it means that there's likely to be a lot of noise. Why? Because there's many participants. Okay, so that's the first thing to understand about breakout trades. It's very, very obvious. Now, the reason why most people tend to fail on breakout trades is very simple. Okay, most people don't understand the basic logic behind what creates a breakout trade. Okay, and because they don't know what creates the basic elements of a breakout trade, they don't know how to execute in terms of timing. Okay, so what ends up happening, if I draw a basic example, we have this really key resistance, great breakout level. Note, nice dark blue line because we've identified as key resistance. Okay, people get long, it goes up, tests, fails, comes back, they stop out. Maybe they buy it again on a little failed break, stops down, comes back. Maybe they buy one last time at the high, stops, starts to turn over, and they give up. Okay, they've taken the loss for the day, probably stopped out on the day. Eventually, later on in the afternoon, the market breaks. Okay, we get the breakout. Now, what most people do in this situation, they go and say, okay, it was a bad breakout. Yeah, it was a bad breakout. Didn't break there, and it wasn't a really good breakout level. Okay, and that's where the analysis ends. That's where the real honest, objective approach ends. Now, what the whole strategy-based templates teach you is that that's not good enough. You don't just go and say, okay, well, that didn't work. We look at all the various elements, every single element around this breakout, from time, relative changes, delta, all these things. We look at them and we break them down one by one by one, because that's where we pick up on the subtleties. Now, this is the reason why so many people end up failing, because they don't know how to time a breakout. Now, before we get on to me showing you the key principles of how to time a breakout, let's just discuss something else that's quite important and pertinent to breakouts. Okay, the first is the auction process. Right, in order to understand an auction process, or a breakout, sorry, you have to understand how an auction process works. Okay, so let's go back to it. Basic, elementary stuff. Sorry, I know I go through these things over and over again, but the whole point is so that you can understand the philosophies, the principles, so that you can ultimately become better at breakout trades. Okay, so the basic premise is that's a discount, and that's a premium. And ultimately what happens is the market will tend to find fair value within that price range until such a point that this fair value is no longer, that should say longer, valid. Okay? Now the moment, and only at that moment, that fair value is no longer valid, will initiative be taken in one direction or the other. And that's the key. That, if there's one thing you take away from that, a breakout. Okay, I'm going to write this. Break. Oh, jeepers. Sorry, guys. Apologies for the spelling. Let's try that again. Okay. The breakout. Okay. It needs initiative. Okay. It needs someone to take initiative. Now, we've spoken about this principle a lot. How does someone take initiative? Well, does it come? We've spoken about the three, obviously, participants. So we've got the influential participants, we've got the algos, and we've got the speculators. Now, what you've got to say to yourself, who can create initiative? Well, it's not the speculative. Definitely not the speculative participants. They can try, they're going to fail. Not the algorithms. Okay? Why? Because, well, by nature, algorithms are very exact in their process. Okay, so, for instance, if they do try and go for the break and it starts to offer, they'll all be scaling out on the way down already. Okay, so the nature of algorithms means that they won't likely be able to hold initiative. So it's only one participant, which is the influential participant, that can create initiative. Now, until such a time that that influential participant steps in to initiate, to move the market into price discovery mode beyond fair value, you will not get a breakout. So I hope you understand that, because that's the premise of it. Now, what I'm going to show you in the next couple of slides is I'm going to talk all about this concept of timing. Okay, because this is the single most important principle when it comes to a breakout. Make a note of that. Now, the reason timing is so important is because we are going in search of the initiative or the influential participant. So if we know that the basic premise
of a breakout is all based on this chap. All we have to do is learn an observation, fact-based approach to identifying him. And I'm going to show you how that is. Now, before we move on to that, let's just talk about some of the other principles that do underline a breakout. So the first one, in order for a breakout to be successful, all participants, will be in agreement. In other words, in order for a breakout to be successful, we need obviously, number one, the initiative. Okay, but what we don't want is we don't want someone suddenly responding on the other side. Okay, so we don't want someone providing liquidity on the other side on a breakout. Okay, so we need all participants, all of them, influential, algorithmic, and speculative. We need them all in agreement. Okay, now the next thing is obviously, how do we determine now our key support and resistance? Okay, we're going to come back to the timing, but how do we determine key support and resistance? Now, we spoke about this quite a lot, over the last couple of units. We also did speak about this quite extensively in Unit 3. I'm not going to go over it in great detail, just very simply. Okay, we can identify a breakout by the break. Okay, and we said obviously the key elements of the break that we're looking for: time, volume, delta, volatility. Okay, so if we have all of those, high volume, quite an aggressive, in terms of time, quite an aggressive move, a delta within the direction of the break, as well as an increased pickup in volatility, those signal a really good break of resistance and support. Now, what we're interested in this entire strategy session is we want two trades here. One, we want to be able to position ourselves for the break, and two, we want to be able to add once we've got the break. Okay, and that's what this strategy session is about. It's about being able to execute twice on the single strategy of breakout trading. Now, some of the key support and resistance areas that you can look at. Now again, guys, I'm going to give you a couple of examples, but this is by no means an exhaustive list. Please understand that. This is not an exhaustive list. You have to go and learn through trial and error what makes good breakout highs and lows. Now, the first example is double tops and double bottoms. Okay. The second type is tail highs and lows, which we've spoken about. Tails, I'm just going to say tails. Then this third type is obviously key swing high and low within a trend. Very key. Okay, so what we mean by that is simply market comes up, maybe rejects a little bit, turns back over. Once it takes that out, it's a key swing. When we extend, you tend to get a breakout. Okay. Then our fourth one, inside days. Okay, so inside days. Okay, important with these inside days, right? We want to identify, is it consolidatory in nature? So was it consolidation or absorption and auctioning? Again, if you can differentiate between the two, you're going to know which is a better breakout than the other. Then obviously, where we have a trend day, the next day, so day 2 of trend, tends to provide very good breakout trades as well. So those are the 5 that I'm going to provide you with, but there are numerous other reasons why a market can ultimately break up or down. Okay, so that's for you to identify and learn through trial and error. Now, let's get to the real integral part of the breakout strategy. Okay, so with regards to timing, there's 5 elements that we're going to focus on. First is absorption. The second is delta. The third is relative change. And this relative change can come in terms of volume or price. I'm actually going to call that price variance. Volatility or velocity expansion. Okay, velocity is just the manner in which prices move. Okay, so if the prices are kind of moving like this, and suddenly it just goes like that, okay, that's velocity. Okay, so velocity expansion, and then obviously imbalances. Okay, so these are the 5 timing, we're going to call them timing clues. Okay, they're the clues. Okay, they tell us that ultimately something's changed. Okay, and potentially this influential participant stepped in. So absorption, I'm going to explain it to you with a breakout graphic. So if I can, I'm just going to use the left side of the board. Okay. So if we have our breakout, again, we're going to use resistance. Okay. So if we have our breakout, obviously, our first one, absorption. So the market might have formed a flag, which is quite typical before a break. So we get this flag, market starts to turn back over, and just at that high point, we start to see the buyers absorbing. So we see someone trying to sell it at that resistance, but the buyers are absorbing, okay, ahead of the break. Okay, this is one of the most consistent ones that you tend to see on breakouts. Okay, so the buyers absorbing ahead of the break. Now what that's going to look like in terms of the delta, potentially a lot of dark blue. Generally it will be a blue color in nature. Why? Because the buyers start to initiate and become aggressive. There's not likely to be much selling liquidity there. Okay, by the time the buyers do become more aggressive, they're actually going to lift through the breakout zone. Okay, so that's why we do tend to see buyer absorption rather than buyers being aggressive initially. Now, the second then is obviously the delta, as I mentioned there. Okay, you're going to suddenly see a shift in the colors. So what you'll typically see, if this is maybe the bar just before a break, you might have been seeing a whole bunch of light colors, and suddenly just before the break you get this really, really dark color. Okay, a nice dark blue or something. Again, a nice visual representation of the sudden shift that's coming from the initiative being taken by potential big participants. Now the third is obviously relative changes in either volume or price variance. So again, what you will see a lot of the time is within this maybe consolidation zone or even absorption and auctioning zone, you might not see a great deal going on, and all of a sudden you'll see the volume sort of ticking across, maybe 1,000 lots every couple of minutes, and suddenly just before the break you suddenly see it move to 3,000 contracts. Okay, again, another very, very important clue that something has shifted. Okay, the game has changed and we're about to respond in terms of price. All right, obviously the price, again, this is another clue you're going to see. I will show you an example of this, but where price, the variance of price changes. So again, if we're used to seeing maybe 5 tick rotations, and then suddenly you get a 12 tick rotation. All right, this is a real clue, again, that something has shifted. The initiative is now being taken. Okay, obviously that ties in with velocity in terms of expansion. So again, velocity isn't necessarily directional. Be careful, do note that. Just like volatility doesn't mean trend. Okay, it doesn't mean that because there's velocity or it doesn't mean because there's volatility or velocity that prices are going up or down. Okay, it just simply means that they're moving over a greater range. Okay, and then the last one is obviously an imbalance. So sometimes what we rarely see just before the break is some sort of an imbalance. Again, the imbalance you're more likely to see when the market isn't necessarily beginning the breakout at the extreme. It might be beginning the breakout here. Maybe the initiative starts, and within that initiative, we initially get some form of an imbalance. Okay, but the most important thing in this early example where the breakout begins early, right, this is obviously giving you a far better opportunity to execute for a much bigger winner in terms of a breakout. Why? Because it's showing you the signal, the timing clue, very early on. Okay, but you have to be aware of the 5 different types of timing clues, and there they are: absorption, delta, relative changes in volume or price variance, velocity in terms of price, and imbalances. Okay. Now let's go look at some practical examples. This is where we're going to really get a good feeling for this and understand this a little bit better. So the first example is the pound against the dollar. This is the 17th of November. And what's interesting about this is obviously this started in the middle of the range. Okay, so I think that's the important thing to note. It did start mid-range. Okay, so breakouts can occur mid-range. And that's why it's so important to know your key levels. Okay, so important. And that's also why we have got our blue lines in place. Okay, so we put those blue lines because sometimes the market might begin the process of a breakout very early on. Now, let's take a little look at the key signal we got here. Now, the first, I'm going to bring your attention to the bottom. Let's look at the volume dynamic. So we can see not a great deal going on. Market began the process of rotating a little bit lower. Again, I will show you this in an example, in a live trading example. But what I want you to focus on more now is the clue. So we can see very clearly the clue was the market tried to go backbid, and straight away someone sold very, very aggressively. Okay, so there was a really big seller. Okay, note, once that buyer had identified the seller, notice how it begins the process of thinning out. Okay, so in other words, we started to see the seller become far more intentional and aggressive. So we got the clue, there's our clue, and the market suddenly responded in a very, very, very aggressive manner. Okay, obviously note some of the imbalances with some of the zeros, some more imbalances, and ultimately a very aggressive wash down. Okay, now some of the key sort of factors that we pay attention to, obviously, we want to see that pick up in volume and delta. In terms of execution, all we're simply looking for is we're looking for that clue. Once that clue comes in, we're looking for an opportunity to enter. Now, the best part about a clue is the stop. Okay, because if we have a clue, where does the stop go? Well, it's very simple. We should not be clearing that clue. So it's very simple. And this is why breakout trading can be so lucrative, because you've got maximum risk reward. Okay, this is probably hands down one of the best risk reward trade strategies you can learn, but only if you're willing to learn the clues. Okay, so we get the clue, we try and execute wherever we best can, probably within that absorption. 320 contracts traded. Once we get the clue, we short, and I think the breakout came somewhere in and around that price. We will obviously see that a little bit later on. Okay, so that's our first example of a clue. Our next example is in the gold market. This time, obviously, we have a little bit more of the traditional type flag breakout, the one you're all familiar with. And again, I'm going to show you a live recording of this. But the real sort of hands down, what's going on here was we could really see that little 163 lot. So you can see if you compare it to what had gone on in the previous 3 rotations. Okay, obviously these are 5-minute rotations. So you can see nothing was going on. No volume trading. Okay, really, really light volumes. In terms of prices, we were averaging, 3-4 price ranges. In terms of the delta, relatively positive, cumulative-wise, nothing going on per rotation. Suddenly, we do, well, not just 10 times the volume on the previous rotation, but double what we've been doing on average over the last couple of rotations. Okay, so there's your absorption, 163 lots. Note, one seller sold into him, so he got filled. So someone reloaded, buyer reloaded, absorbed. Once the market picked up on it, notice a little bit of an imbalance here. Okay, so 11 goes to 18, 0 goes to 39. Again, another little imbalance, 39 to 129, 15 to 71. So that was the beginning process of initiative being taken. Now again, this is our clue. Our execution will probably take place somewhere here where we can get liquidity away, and we want to be in ahead of the break, and this is where the break occurs. Okay, so we can see the break occurs just above that 92.5. Notice the whole bunch of stops on the break and continuation. Also notice the volume pickup as well as the delta and the delta on the day. Okay, so that's our second clue. And again, I know it sometimes seems easy, but it is that easy, guys. You just have to learn to observe the clues from the markets rather than trying to anticipate, rather than trying to second guess yourself. Okay, you're simply waiting for that clue. Bang, when that clue's in, you execute. Okay, now what we're going to do, we're going to have a look at one more example. This is now in the gold again on the 5th of December. Again, a 5-minute rotation. Now, this is the second strategy. So obviously, we've spoken about the 2 types of execution. One is on the clue ahead of the break, and we want to be in on the break. The second is then, once we've had a breakout, the first pullback. Okay, so we've identified a good breakout. We wait for that first pullback, and we can see, very simply, obviously, market has a nice exhaustion low. We've spoken about those in previous units. Tries to take a breather, comes back and tests, obviously, a pocket positioning or a high area of liquidity that was previously provided. and holds that point as resistance, not just once, but twice and 3 times before continuing lower. Okay, so that would be our second entry point, which would be that first pullback. Now note what I would say. What is very different, and this is a rule of thumb, okay? With a breakout, what I want you to do is get rid of all the other understanding you know, for instance, exhaustion, low and highs, okay? Because like I've said to you, every one of these trade strategies has to have some form of context. Now, a breakout trade strategy, by definition, is all about price discovery. Now, when a market goes into price discovery, it's not a one-off feature. Okay, so it's not like we break, pull back, and then stop, and then come back down. Okay. Yes, when that happens, we have a failed support and resistance. But more often than not, a breakout, we have the break, we pull back, and we're more than likely, very high probability, going to always extend and continue the function of price discovery. Okay, and that's the key, guys. Right? If you know breakouts, good breakouts will always form some form of price discovery. You can execute once, early, ahead of the break, make good money, take your profits on the exhaustion because you've learned that principle, sell the first pullback, okay, and hold on for the second extension. 2 trades, 1 strategy. Okay, now let's take a look at one of the examples. And the first example we're going to look at will be from the gold. This is on the 27th of November. And like I said, obviously, this is the breakout I was showing you on the board. Now, I'm just going to fast forward it to that point so you can see what it looks like. 163 lots. So all we're going to really focus on is this clue being provided. So again, like I said, note the variations. Nothing really going through the market. Really, really light in terms of volume. Not a great deal going on. We can see the market comes down. And all of a sudden, we start to see someone selling. But equally, someone reloading the bid. Okay, and this is what we call buying absorption. Right? And note where it's coming. It's so important. The buying absorption needs to come at the extreme point. In other words, ahead of the break. We don't want to see it down here on the candlestick chart. Okay, we don't want to see it at the base of the consolidation area or distribution area. We want to see it towards the high end, so just ahead of the breakout. And that's our real clue. Okay, so we can see real absorption going through. You can see the delta picking up. The moment the market stops selling to him, note what's happened. So notice once that pauses, there it pauses. Straight away what happens? Bid up. Straight away the markets realize that someone is sitting there reloading. And obviously all of a sudden the market responds in kind. So we get the bid up. Straight away we see a little bit of initiative coming in. And the market then suddenly decides to take the break and continue high. Now again, as you can see, a little bit of a double top on the dailies in the gold market. Again, notice the volume shift here, guys. This is really key. Look how the buyers are shifting their intentions. Okay, no dark blues in any one of the previous rotations. Suddenly a lot of dark blue, no selling. Okay, 1 lot sold, 10 lots sold, 28 lots sold, 0 lots sold, no selling coming in. Only aggressive buying. Again, notice the reload at the highest price of the day. Okay, really aggressive reload there at 92s. Straight away back on the bid. Buying the market at the best price available, 129. Straight away up to the next best price, 71. No selling coming in. And all of a sudden, we're going to see the market panic to the upside and take some stops. Okay, now note, in terms of execution, we obviously do want to get in when this absorption is taking place. If we're not in, again, yeah, you might be able to get a fill around that 1 lot, but remember, you are then at the mercy of a seller. And we can see there's really a real lack of selling coming in. So by waiting, you're simply adding to the risk of your trade. Again, note the 158 lots, quite an aggressive amount of buy side order, where at the high of the day. Okay, and that's the shift in dynamics. That's the real clue that something has shifted and the breakout is about to occur. So I'm just going to fast forward this slightly. We can get to that breakout point. And let's just take us 1 step back. Okay, so we're just going to watch this for another 20 seconds and then we'll move on to our next example. So again, we can see a little bit of selling step in. Okay, so a little bit of selling, 92s, and what we said, if we do get fortunate enough, we ideally want to get in where any one of that really aggressive intentional buying stepped in. We saw it both at the 129 but also the 71. It did come down and give you a chance. It gave you 21 lots filled. Straight away back but up. And again, if you're watching the price ladder, you can see the market very aggressive, moved up there all the way to 1295. So a real 30-40 tick move in the market. From what, 92s? I mean, you would have been buying somewhere around 92s up to 95. So a good 30 tick move in the gold, and that signals out then the breakout. Now let's move on to our next example. This is going to be a breakout now in the cable. Again, remember this is obviously mid-range, so you can see this is why it's crucial, because I want to show you guys, I want to dispel that idea that breakouts occur just the extremes. They don't. They can occur from anywhere. And that's why we have the clues like, price velocity shifting. So important. You always do analysis. You always have those blue lines so that when that velocity shifts, you can simply execute. So what you're going to see here now is, the cable is sitting in a relatively sideways range. Note, nothing going on. Okay, really low volume, nice light colors, zero change in the delta. We do, however, have a negative delta on the day, so there's quite a negative delta on the day, but prices are sitting quite close to the high of the day, which is quite fascinating. Now, note what's just happened here. Straight away, the market's come up, and we've seen a relatively aggressive buyer. Okay, now this is a real subtle clue, because something's changed here. If I just saw this now, I'd be really switched on. It doesn't necessarily mean buy or sell, but something's changed, because suddenly we've seen a buyer not just take 200 contracts, but he's also then bought 123. So really, really aggressive intent taken from a buyer. Get what happens to price. It goes in the opposite direction. Okay, and that was our subtle clue. Now, you're going to see how this plays out over the next couple of minutes. Ultimately, we start to see a little bit of an imbalance form in the middle of this rotation. These are obviously 5-minute rotations. And suddenly, we start to see the market move slightly lower and lower and lower. Okay, so we got the signal early on, and all of a sudden the market begins a process of initiative in the opposite direction. Okay, note the imbalances again. So we had imbalances higher up, imbalances lower down, and suddenly the market begins a very rapid process of unwind. Okay, I just want to get back to that break point. So again, just note, guys, it's not always that a breakout is going to be suddenly huge or big. Okay, obviously note we did have a little bit of an outside candle. Okay, note the change in volume, note the shift in delta. That was our real clue on that previous rotation. There was a sudden shift in the game here. It was a game changer clue before we then got the spike. Okay, obviously that was 30 ticks in the cable market. It did extend a little bit lower, another couple of prices all the way down to 20s, and it continued to flush down until it found some responsive buying. Okay, and that was our breakout, guys, but we would have only been able to take advantage. We can see on the candlestick chart, that was our area there. We would only been able to take advantage of that breakout had we recognized the fact that, one, we had a key breakout opportunity, but also, two, the subtle clue was there. Alright guys, that's then the end of our breakout strategy session. Let's go now and complete some of the templates for breakout trading.
context, note we spoke all about the consolidation, and we want to look inside that consolidation. As you go through this template, make sure you focus in on that consolidation, view what it looks like, look at all the elements within that consolidation, and make sure you're really taking in the objective information inside of that consolidation. Now note, we want to draw out the clues from that consolidation area, because those are the clues that we want to keep drawing out whenever we complete a template on breakouts, to ensure that if we get new clues, we're aware of them. If we get the same old clues, we want to be capitalizing on them. Okay, then in terms of obviously balanced and imbalanced, it's more important to actually identify breakout points, all right? Again, I don't want you to get too fixated on whether it's better or worse imbalanced or imbalanced, but more so what makes a good breakout zone and what doesn't. So again, when you complete this section, really go and drill down what was the reason for potential breakout, what led you to believe it was a breakout. Write down all these things, really observe that potential breakout point, because again, you want to develop a methodology to determining what is a potential good breakout zone and what isn't. In terms of trade location, well, obviously I did give you a couple of ideas for breakout zones, like double bottoms, double tops, tail highs and lows within a trend, key swing reversals within a trend, inside days, and day 2 after a trend. As well as, obviously, I mentioned there are numerous others, so just make sure you adopt these as well as any others you might have. Now, in terms of then conditioning, note we obviously said for breakouts all participants are in agreement. So just make sure when you are reviewing and adding to the template that all the participants are actually in the same direction. If, for instance, you find that as a market breaks there's a really high degree of response straight after the break, again make a note of that, because what you'll find is when you see that the breakouts don't tend to be as clean. So again, observe every single thing that takes place in terms of conditioning. Liquidity should be low on a break, as all participants are in agreement. So again, highlight it if it isn't. And then obviously volatility. We do expect volatility to be subdued in consolidation before breakout, but once we break, we expect a pickup in the volatility. Okay, let's now go and have a look at the identification of a good breakout strategy. So obviously the interaction is the real key. If we were to summarize really the entire strategy session, it's all about that moment, that calm before the storm, that real moment before the explosion and the breakout to the upside or to the downside. And where you're going to really get good at this strategy is focusing all your energy on the interaction side. So spend a lot of time thinking about where does the initiative come in, where does the responsive come in, in a good breakout that gave a really big reward and a really big target, what was the early initiative like? Was there any kind of response? What was the conditioning behind that interaction? And that's the real the nuance behind not just this strategy but all the strategies. Obviously, in terms of interaction, we expect aggressive interaction. So again, note, is it aggressive? Is it not? Again, in terms of timing clues, these are the clues that you definitely want to look out for that we went over. One will be absorption, delta coloring, relative changes in volume and price, volatility shifts, velocity expansion, as well as imbalances in the market. Obviously, as you complete more and more of these templates, guess what? You're going to find more clues. Equally, you might call a clue something different. Okay, it's all up to you. The point is, I'm trying to get you guys to get into a very strong habit and a process of ultimately developing this breakout strategy for yourself. In terms of the metrics, then we want to focus on volume. It should be high on the break as all participants partake. So just watch that volume again. Low volume breaks do tend to fail. In terms of time is a key metric as there are positions locked in once everyone is in the same directional position. So obviously the longer we take to move in that direction, the more likely a potential for a failed break of support and resistance is. Then in terms of delta, look for those dark shades, look for the light shades, look for the imbalances, point them out. Where are they occurring? Why are they occurring? What does it mean? In terms of cumulative delta, obviously it should move in the direction of the breakout and it should accumulate in that direction as well. If it doesn't, note the divergence, okay? Sometimes we do see not just delta divergences which create an exhaustion high or low, but also sometimes a potential initiative or a key auction reversal. And then obviously relative changes, note the relative changes you're observing, note what they could mean and what they could mean in terms of time, price, velocity, delta, volume and speed. Okay, let's have a look now then at the execution of the breakout strategy. So obviously, again, money management, crucially important. We're going to be quite aggressive on this breakout, as well as passive. Aggressive for good reason. We've got potential for great reward. So it makes sense to potentially, if a clue is there or if the signal gets given to us, we do have a little bit of a preemptive strike, simply because the reward is there and it's justified. But also, once we do get that break, we take a little bit more of an aggressive approach on that breakout. So we use both a passive and aggressive approach to execution. In terms of risk, we obviously place the stop below that signal or back inside the breakout zone. In terms of target, well, until the market begins the process of providing liquidity. That's the real key to breakouts. The market is going on a price discovery mode, so it will stop once it runs into liquidity being provided. Do note, obviously, breakouts do tend to extend, so don't be afraid. Like we mentioned in terms of the variations, you've got variation number one, which is the breakout. Take your profits when the market signals it and buy that first pullback, as the probability for extension on breakouts is always very high. Risk reward, highest of all the strategies we're going to go through, and obviously we have a very, very small risk, and we've got really good methodology in this trade strategy, but do recognize the fact that everyone can see a breakout trade, just not everyone knows the subtle clues of when that initiative is stepping in and when those participants are stepping in, and ultimately when you should execute that breakout. Okay, in terms of application, well, obviously, like I said, you can be exact on the breakout, so you're looking for that exact break of a price. That's just before the break. But equally, we can be a little more preemptive if we get one of the signals as mentioned. Leveraging, this is a strategy you can get highly leveraged on, simply because you've got really good reward, very tight stop, and ultimately the potential for a very good gain. All right, in terms of the tip, the entire universe can see the breakout. Okay, note that everyone can see a breakout opportunity. However, successful participants employ a consistent approach to breakouts. Learn it and don't forget it. All right, guys, let's now move on to the next of our additional readings. So this is the second recommended book from Ryan Holiday. Obviously, the first was The Obstacle is the Way. The second is Ego is the Enemy. Great book, fantastic book. It really provokes your thought quite a lot. Note a summary of it. It's a researched understanding of how and why of the ego. So it gets you a really good understanding of why people develop an ego. What makes even people without an ego suddenly develop one. And ultimately, why is the ego such a bad thing? Now, in terms of action, very thought-provoking. And it's definitely going to give you a mindset shift. It's definitely going to make you want to adjust how you think about the ego and what it ultimately means. Now, in terms of the key highlights, consistent questioning your own understanding of the self and the ego. I think this is the key takeaway. You're going to constantly be saying to yourself, well, do I have an ego? Is it creating bias in my understanding? Is it creating block, a lack of growth mindset, all these sorts of things? Always stay a student. This is one of the key highlights. Understand we can always grow, learn, and strive for a better version of ourselves. This is one of the key highlights. With an ego, we can't grow as effectively, and this is something the book does spend a lot of time going over. Obviously, then, ego is a natural occurrence, but with practical solutions, you can tame it and control it to make better decisions. So again, it's not about eradicating the ego. We've all got it. We have to live with it. But it's about understanding it and what role it ultimately plays within us, and how we can utilize the ego ultimately to our advantage rather than to our disadvantage. And then lastly, obviously, to measure the performance, not on outcome, but with a scorecard. Now, this is quite cool. A great little last section to the book. So yeah, highly recommend this book. Again, it is there for you to provoke your thought ultimately and give you better understanding of how your ego might ultimately be standing in the way. All right, let's go wrap up then Unit 13 in the drill section. This then brings us now to our drill section. This is the final slide of Unit 13. You know the drill. Go and watch the drill, complete the template, be accountable to that template. Watch the guided tuition drill, make some notes, compare some notes, make some adjustments. Watch over some of the videos we've dealt with during the units and during the practical session. And then when you're confident, move on to Unit 14. Now before we move on, a lovely little quote from Benjamin Franklin. We are all born ignorant, but one must work hard to remain stupid. Okay? It's a fantastic quote, and why I like it is that it really pushes home this idea that unless we have a growth mindset, unless we're willing to continuously be learning, growing through failures, through trying things, unless we're willing to do this, we're going to forever remain ignorant. So in order to be that little bit less ignorant, you're going to have to be willing to grow. Thank you, and I'll see you guys again in Unit 14.
So welcome then to Unit 13, Strategy 8. This is all about breakout trading. Now, this is a fantastic example from the WTI oil on the 1st of December. We are using a rotational, point and figure rotation here as the setting on the footprint, which is best for breakout trades, or at least momentum trades. Now, the first thing before we get stuck in is, the whole principle, of breakout trading. We really buckled down and identified what it is that creates a breakout trade. Why it is that so many traders struggle with breakout trading and struggle to really find some form of consistency. And it all came down to timing. And we spent a lot of time developing, what are the timing elements we can view to see those sorts of breakouts coming. Now, don't forget, like I said, everyone can see a breakout. It's pretty obvious, as you're going to see in this example. Above these 95s, a pretty key area on the charts. The real art is in learning, when the timing is right for the breakout. Now, I'm just going to push pause here and go over one or two things that we can see at hand. So we can see the market's kind of gone into a little bit of a accumulation distribution phase ahead of the break. Now, the key is within that accumulation and distribution phase is to be aware when that break could potentially come. Now, the real standout factor, we obviously mentioned a number of factors that we can observe before the break, but in this example, the real standout factor is pretty much the sudden shift in the volume and volatility. So, in the previous rotation, we can really see how the market came down. Again, it got rejected at these lower prices. We can see it, it came all the way down to the 78s, traded 46 contracts, and went straight back, but up. But on the way down, note the dark blues. Okay, some real chunky absorption took place at these higher prices. Now, yes, we can argue there was quite a bit of absorption in that previous rotation, and hence we should have been looking for longs in that previous rotation. That is fair enough. However, that being said, there's one key little subtle clue, okay? When we have this absorption ahead of the break, we want to see that absorption as close to the extreme point as possible. Okay, that's the real key. All right. Obviously, this absorption does signify that buyers are willing to be buying higher and higher, but we really want to see that absorption coming in around the high. So that's what we're going to pay attention to, as well as obviously the shift in the volume and price dynamics. Okay, so we've come back but up. Note we are seeing a little bit of sideways absorption here. Again, we want to be seeing a lot more than that, 3, 4, 500. We want to see a shift in dynamic. That's the real key to being aggressive with the strategy, is identifying when that shift occurs and then being relatively aggressive. Okay, let's just move this on a little bit further towards the break. Okay, so again, now note what's happening here, okay? We can see quite a bit of sell-side absorption coming into the market, 520 lots traded. At the same time, we've got 400 lifted. So, we're starting to see, again, just a shift in dynamic. There's a little bit of a change up in how the buyers and sellers are ultimately interacting. Now, again, we can see the market went up, it tested those 94s, and remember what we said. At the present, we can see, 0 by 31, there was reluctance to lift. 0 by 79, reluctance to lift through that price. 0 by 18, reluctance, and bang. Okay, so I'm just going to go back there a couple of seconds, because there's a real key, and you have to be quick here. I'm not going to make it sound as though it was slow. But watch what happens the moment we begin to trade more than 16 lots at the high. Okay? So just before it, notice how we're lifting 183, straight away the market goes bang on 207 trades, and straight away we see stop outs. Now remember, obviously there was an area for stop at 95, and the moment that 180 lot got lifted at 94s, we saw the market stop up. So it was a very subtle clue, but very quick, probably not the easiest clue to get on. Again, there had to be an element of preemptive strike, but we did talk about, sometimes you do have to preempt when the necessary reward is there, and it's going to pay you for that preemptive strike. Okay, so that was the real subtle clue. We obviously got that real absorption before we, rotated back to the high. We then got that last little bit of it. We got, again, some more absorption at the higher prices before that one last lift. We saw the commitment at 94s before the market then stopped up. Now, ideally, you don't always want to see it happen that quickly. You want it to allow you to give you a chance. But ultimately, now that we've had the breakout rules are ultimately in play. Now, what are those breakout rules? It's simple. If we're not on the initial breakout, we're looking for the market to ultimately pull back, absorb, give us an area of absorption, and allow us in where people are searching for liquidity. Now, do note obviously the low volume area between 94s, 93s all the way up to 09s. This is a low volume area but also an imbalance area. So long as that holds, the breakout is good. Now we can see that market extending quite aggressively to the upside. Note the overall volume trading as well as the delta. Now, very interestingly, note the volume that we had in that previous rotation just before the break. Okay, so like I always say, you got to look for those subtle clues. In essence, there was a subtle clue that something was brewing. It was the highest volume rotation we've had in this example, and it came just before the next rotation, which is when we got that snap high. So the clues were there, the subtleties were there for the breakout opportunity. However, that being said, if we do miss that opportunity, we wait for the market to run into some responsive selling, let it pull back a little bit, and we enter upon the absorption points. Okay, so again, we can see the market forming a nice aggressive accumulation and distribution. Note the high volumes signaling that out. So again, we continue to see the market move sideways. Market comes down. I just want to show you that point of absorption. So again, note the dark colors, guys. Really, really evident that we are seeing buyers sitting, absorbing whatever they can. Not just once, but twice. Okay, and the market comes down again a third time. We see again absorption at 25s. Alright, so this market enters a phase of sideways trading. Now let's go and have a look at how we could have got in here. Okay, obviously, in terms of the breakout, we're looking for a pullback point. Okay, like in the initiative drive, there's no exact pullback point. There's a number of things we can look at. Obviously, we can look for previous, key absorption points, maybe around the 10s, 11s, or maybe even the 12s with some really good absorption there. We can look for a fill of maybe an imbalance, or we can look for, maybe a key previous swing high low. Okay, so we're looking for anything ultimately that gives us an idea of where we can enter. In this example, again, notice the dark shading. I think that was the real clue here. We're seeing not only some very aggressive selling being filled, in other words, buyers are happily reloading, but the buyers are also buying at the same time. Okay, that's a real good strong signal that the buyers are quite intentional around this point, and that ultimately then acts as our stop down before the market then returns back higher. So a really, really good example of a breakout. Do note obviously with the breakout, where we get out, or once we enter, whether it's on the first break. If we're on the first break, we don't want to get out until we have that secondary extension. If we're getting in on the second pullback, okay, again, we're looking for that extension, trailing that stop with the momentum. We don't really want to be entering back in to that previous rotation. Okay, so that's then our breakout example, a really neat example in terms of entry points, in terms of signal points, in terms of targets. Again, I don't like to spend too much time, mulling over targets, because it's a personal thing. Where I get out, where you get out, where everyone gets out, it all depends on what we're ultimately trying to achieve. Just remember, obviously, with breakouts, they do go into price discovery mode, which means by that very definition, the market should go a little bit further than what you might think. Okay, the breakout is purely dependent on where the liquidity is provided. So if someone's willing to provide liquidity, the market will stop. If they're not, the market will keep going until it finds the desired liquidity. Okay, that's then a wrap up of our drill session on the breakout strategy. Join me again when we go to Unit 14.